Hello everyone, I hope that all is well. I just want to take this opportunity to go through some of the basics when it comes to financial instruments. Remember, you need to familiarize yourself with international accounting standards and together with the international financial reporting standards. So I'm referring to the IAS. To be specific, IAS32, which deals with specifically with the compound financial instruments. And then again, you must be able to apply your IFRS 9 so that you can be able to know how to use the applicable rates. By applicable rates, I'm referring to the effective annual rate, of which we have to use in most cases in order for us to be able to calculate the interest. Please make sure that you familiarize yourself. This is just going to be a short video. I think you know me by now, Sylvester Simono, and this is my email for any other correspondence. I always try by all means to reply. Okay, let's not waste time. I just want us to look at this question. Maybe this question will make the difference. As you can see here, I have, I'm going to highlight as is. Here I have on the 1st of May, as you can see here, Malobi issued debentures at a fair value, okay, to a local investor, Prosper Ltd. The number of debentures issued were 82,500, okay, and they will mature on the 30th of April 2023. The coupon interest rate is 9% per annum, and of which the nominal value of that was how much? Was 220. Okay, so obviously here we're just trying to analyze the information. Okay, the market interest of the similar debt instrument having no conversion rights was 9.35. Okay, so this is the 9.35 that we're going to use in order for us to discount this particular future value. Okay, and we also incurred the transaction cost of 220, of which were paid on the 1st of May when Malobi issued those debentures. Okay, remember, if Malobi issues those debentures, in other words, these debentures will become our liability because we are the ones who are issuing. It means someone is going to buy those debentures from us. It means we owe them. We have to repay them with the interest. Okay, let's analyze further. The debentures will be converted at an option of the debenture holder into the ratio of 1 ordinary shares for each debenture held. The Malobi did not elect to irrevocably designate its financial liability to be measured at fair value through profit and loss in terms of what? IFRS 9.422. So again, they did not elect to classify the financial liability according to what? To the profit and loss. Okay, so meaning at the end of the day, we need to make sure that when we deal, especially with the transaction costs, we need to make sure that we know how to deal with those transaction costs. We need to check if we need to capitalize those transaction costs or not. Okay, remember, from Malobi's side, these debentures will be a liability because we are issuing. But firstly, we need to make sure that we find the liability part of this. Remember, here we are going to, we have got an option on converting those debentures into ordinary shares. This means that this particular financial instrument is a compound instrument. Why do we say this is the compound instrument? Is because there is an element of equity and liability in it. So in other words, we have to make sure that we use what we call the split accounting. In other words, we have to make sure that we calculate the liability component and thereafter we must calculate the equity component because of the option to convert. Can you see now? So now we need to make sure that we analyze this information so that we can understand better. Okay. firstly, we need to make sure that we discount this in the future value. Remember, this debentures were 82,500, and then at the nominal rate of 220. So this 82,500 and the 220 will give us what we call the future value. So this is what we are going to do. So what we are going to do, we're going to say, okay, it's advisable here to use a financial calculator, because or if you can use the amortization table, so sometimes it's not easy because of time, you will end up wasting your time. So what I'm going to do, I'm going to say, okay, for now, I'm going to look for present value. So present value is what I'm looking for. Can you see now? So I'm looking for the present value of which I don't know at the moment. For now, I'm just going to say PV, because I need to discount this future value so that I can know the present value of this particular future value. And that present value will act as the liability for this particular entity. Okay, so the present value is what I'm looking for. And then let's see what they gave me. I do have the future value. Because remember, with the future value, I'm still writing it up here. So we have got 82,500, and then we need to multiply this by 220. Okay, so if we multiply 220, if we use our calculator, let's try to use the calculator there. Okay, let's use the calculator. So according to my calculator, I get 18,150,000. Can you see now? So it means I do know my future value because they gave me the nominal value. Remember, so what we need to know is to find the liability component. We need to discount this 18,150,000 so that we can know how much is the liability. And thereafter we can check. We do have. Let's check if we have got any coupon. Yes, can you see we've got the coupon interest of 9%. This will represent the payment, the annuity that we're going to have. So according to our calculator, the annuity is called PMT. So our annuity is going to be our future value of 18,150, 123, and then we multiply by that. How many percent is that? It's 9%. Okay, so if you multiply 18,150,000 by 9%, let's calculate and see. Okay, let's calculate here and see how much we got. So I get 1633,500. Remember, guys, sorry if my figures are wrong, please bear with me for now. So, but as long as you can see the principle, I'm trying to show you the principle. Can you see now? So I have got the annuity, the annual payment of which is going to be 1,633,500. Can you see? So at the end we do have the PMT. Okay. Remember, here we've got an option. In other words, we're not ruling out any cash option. So it depends at the end of the day. That's why we do have the future value here as 18,150,000. Again, we need to check the number of periods. So if you can check here, from the 1st of May 2019, they say this will mature on the 30th of April 2023. So if we count, so May 2019, I'm going to have 2020, 21, 22, 23. So my number of period is going to be 4 years. So I'm going to say N equals, sorry guys, I don't have a ruler here. It's going to be 4 years, because yes, you can count. You can even have a timeline, and can you see from the 1st of May 2019 to 30th of April 2023, you will find 4 years. Okay. And again, here, remember, we are lucky enough, they gave us the effective interest. So the effective interest here, the effective annual interest, according to the information here, it means, how much is it? Let's see, the effective interest is 9 point. Can you see now? That is the market interest rate. That is the effective annual interest. Remember, the effective annual interest differs from the nominal interest, because the effective one has take the other factors into consideration. In other words, it has got features of compound. It is compounded. So when you see market interest rate, just know that this is called the effective annual rate. They took into consideration most of the factors in the market, like the inflation and other things, and it considers the compound nature of this particular interest. So the nominal interest doesn't cater for that. Like, for example, the 9%. Normally, the banks, when you are investing, they use what? The compound interest. They use the market interest rate. Can you see now? So of the similar debt instruments. So 9% is just the one that is quoted, and it doesn't have the compound feature. Okay. But again, for more information, you can check when you go for, let's say, for example, those who are still doing the undergraduate studies. You'll see, especially under the financial management, you'll find that they normally ask you to calculate the effective rate, and they will give you what? The nominal rate. So you can manually do it with the formula, or you can use a financial calculator. With a formula, for example, that formula is where you say 1 minus, if you remember, m, and then in a close bracket to the power m minus 1. But that one is a story for another day. Okay. So thereafter, so our interest is going to be 9.35%. Okay, so here we have got all the other variables, but except what? The present value. So now it's time for us to find the present value. And how can we find it? It's advisable for us to use like the financial calculator. Okay, so we need to make sure that we understand how to do this. Okay, so let me just use my calculator quickly. And then, even for time being, guys, please just try to calculate. And I'm still trying to find my calculator so that the financial calculator. Just hold for a moment. So let's calculate here. Let's see this. I found my calculator. So I've got my future value of 18,150,123, future value, and I've got my PMT 1633,500. PMT, remember, it depends which calculator are you using. We've got 4N, we've got 9.35 interest, and I'm looking for the present value. Okay, so according to my calculation, my present value is, please correct me if I'm wrong, is 17945,768. That is what I found. Okay, that is what I found. Okay, so this is what I found. So this is what I found as my present value, and this present value will represent my equity, my liability component. So let me just write it here for the future reference. So this one, let me just write here. This one, I'll just say it represents my liability. Remember, for now, I'm not showing you how to record in the books of accounts. I'm just showing you how to calculate. Maybe at a later stage, I will show you how to put this in your books of accounts, especially when it comes to the general journal, because they can ask you for the general journal. Okay, so this one I'm going to call it a liability component. Okay, because we are dealing with compound financial instruments, it means we need to apply what we call the split accounting. So this 17 million will be the liability component, meaning the remainder will be the equity component. So what we can do, we can say, okay, therefore, because I'm gonna squeeze it here, because we have got a liability component. Okay, I'm gonna write it here. Let me change the color. Because we have got the liability component, is how much? Is 17,945,768. Okay, and then if the total, remember, all in all, the amount that I will get from issuing this, in other words, I'm referring to the proceeds. So the proceeds will be this amount of future value. So the proceeds will be the total. So I'm gonna put it here. So I'm gonna put it here, the proceeds. I'm just gonna call it the proceeds. In brackets, I can just write that future value so that you can know what I'm talking about. So according to this, the proceeds will be 80,150,000. Can you see now? This will be the proceeds, okay? So meaning, if I take my proceeds and minus the liability component, I will get my equity component. Can you see now? So let me just change the color. So my equity component, and let me just put it here, will be the difference between the two, the equity component. Component will be the difference between the two. And then how much will be the equity component? So the difference between the proceeds which I had and the liability component. Let's use the calculator and see how much do you get. I get 204,232. Can you see? So this is my equity component. Can you see? So again, that's why I said we need to use split accounting. So before we can go and record in the books of accounts, we must make sure that we split them. Can you see now? So all in all, when you add them together, they must give you this amount. Can you see? This is the total, the proceeds, the future value. So we minus the liability and we find the equity component. But can you see, the only way we can find the liability is to discount this future value, which is the proceeds. And when we discount that, we call this the present value. So this present value represents the liability component. I think that you are following so far. And remember, like as you can see here, Malopi did not elect to present this financial liability at fair value through profit and loss. In other words, we cannot expense these transaction costs. As you can see, we've got transaction costs here. So we cannot expense them. We cannot take them to the profit and loss. What we need to do, we need to make sure that we go and then affect our liability component and equity component respectively. Remember, in the books of this Prosper Ltd, this liability component will become a financial asset for that particular person, for Prosper Ltd. So in their case there, the allocation will be a little bit different. So for now, because I'm doing the liability, I need to make sure that I allocate. So let me just write this. I must allocate this transaction costs to this components. So I'm gonna write let me just put a heading here. You can just say allocation of transaction costs to both components. Let me just say to both components respectively. Okay, so this is what I'm going to show. I'm going to allocate. So let me do this. So I'm going to show you how to allocate those transaction costs. Remember, the transaction costs are how much? Let's go and check. 220. So what we need to do, remember when you did, some of you maybe are still doing the accounting 1B. If you are doing accounting 1B, remember under partnership, we used to divide the profit of the partnership amongst partners using the ratio. So again, here we're going to use the same logic. So here the ratio, we are going to use the liability component and the equity component as the ratio. So can you see now? So the liability component, obviously, I'm going to take this 17 million and I'll divide by the total. Remember this proceeds. So for liability component, let me change the color. For liability component, I'm going to say liability component. I'm still writing. It will reflect liability component. component is going to be, the calculation will be 17,945,768, and I'm going to divide by the total of 18,150,000, and I'm going to multiply this by the 220. Remember, I'm trying to divide this amongst them. Can you see? So the liability component, can you see? That is going to be 17,000, and then you multiply by that. How much is the answer? Let's see. I'm going to put the answer here at the bottom here because of space. So let's see. Let's use the calculator, guys, and see if we can be able to find it. So use a calculator. So on my calculator, guys, I found 217,524. Remember, guys, if the figures are not correct, especially when I calculate, please bear with me. So I'm just trying to show you the principle. Okay. So in other words, the transaction cost allocated to the liability component will be how much? 217,524. Can you say 200,000? Obviously, you can see the figures is still it's at night, so I can't read properly. So 217,524. Can you see now? So this is the amount that we are going to allocate to the liability component, which comes from the transaction cost. So obviously, the remainder of this will be allocated to what? To equity. But again, you can, if you want to use the same method, you can say for equity is going to be 204,232. You divide by 18,150,000 and you multiply by 220. But the easiest way is to just find the difference. The remainder will belong to the equity component. So the equity component, the easiest way is to take 220,000. Is it 220,000? Yes, and then I'm gonna minus 217. Can you see that is the short way of doing it? 524. So let's use the calculator. How much do I get? Let's use the calculator. I get 2475. Okay, so that will be the transaction cost allocated to what? To the equity component. Can you see now? So again, guys, you need to follow this step by step. It is not that difficult, but you need to understand the standards, like I said before. Make sure that you familiarize yourself with this IAS32 and then IFRS9. So at the end of the day, please make sure that you go through this. So immediately after doing that, remember, this transaction costs at the end of the day need to go and affect a liability component. Remember, these transaction costs were paid by Malope when we were issuing these debentures. So in other words, this must reduce our liability. Remember, if this was an asset at the end of the day, the transaction costs were supposed to be capitalized on that particular financial asset. But again, because this one is a liability, so we need to make sure that we reduce the liability because these costs were incurred by us. Okay, so we need to make sure that we go and affect the liability component. But because we are going to affect our present value, remember the liability component comes from the present value. It means we are compelled to make sure that we calculate the adjusted effective rate. By the remember here, this effective rate was given to us. So now we need to make sure that we go and adjust this 9.35. Why? Because we need to incorporate the transaction costs which have been allocated to the liability. Meaning I need to have something like this. I've got PV, FV, PMT, and something like that. You see, and we must make sure that we incorporate these changes, the transaction costs. So what we are going to do, we're going to calculate the new. Let me just write it down so that you can understand what I'm talking about. So we're going to have a new. Let me change the color. I'm just gonna put it in short here. I'm gonna say effective annual rate after transaction costs. It will make sense if I do it like this. I'm going to calculate the effective annual rate after transaction costs. So I'm going to make sure that I do that. Okay, so it's a liability here, and then yes. So we issue liability. So we remember here we issued debentures. It means we received that particular cash at the end of the day. So what I'm gonna do, I'm gonna make sure that I populate the way I populated before. I'm gonna remember my main aim is to find. I'm trying to change the color. My main aim is to find the new rate. So I don't have to find the present value because I've got the present value. So I need to make sure that I just adjust the present value. I give the present value, and the okay, PV equals. Remember the present value that we found 17,945,768. And then remember, we need to minus the transaction cost that we got here. The transaction cost that comes from the liability component, remember this one, minus 217,524. And how much we get? Let's use the calculator, guys. So 17,945,768 minus 200. So guys, I find something like 17,728,244. Can you see? So this is what I found as my present value. Okay. And then again, I do have my future value. I'm gonna put it as it is. The future value equals, we did calculate on top there is 18,150,000. Okay, and our PMT again will remain the same. Our PMT is going to be 16. Remember, we did calculate everything on top there. We're just copying that from the top. And the number of years, remember, still the same. The number of years will be N. And then N is going to be 4. But at the moment, what are we trying to find? So we are trying to find our adjusted effective rate after taking the transaction costs into consideration. So I'm going to find my I now. How much is my I? So we need to make sure we put everything on the calculator there. Okay, so we need to make sure that we put everything on the calculator. Okay. So remember, this must be in brackets. Remember, this is a liability, so I'm going to put this in brackets so that you can make sure put this in brackets. Put this amount in brackets. Okay, so put it in brackets. According to my calculation, what do I get? I get 9.73. Let's see. I'm gonna put it here, guys, so that you can see. I'm gonna put it up there. So my I will be 9.73. Hopefully I'm correct, guys. I'm using an HP calculator, so yeah. So, but some of you maybe are using a different one. So I found my adjusted rate of 9.73. Can you see now? So again, this 9.73 is going to be used by the time when I calculate my interest. Remember, from here, I'm going to use an amortization table for me to be able to find the interest for each and every period. Can you see? So again, remember, from here, if you want to find the interest, you have to, for the first period, you must say 1, and then you press input on your calculator, and then you go and find amortization, and you say equals. You'll find the interest which will need to be accounted for each and every period. But the accounting part of it, I'm going to show you with the next video. If I can manage to make the next video, guys, I'm going to show you how to transfer this information. So what I can tell you at the moment, just roughly, is because here we've got the liability component and we've got what? The equity component. So remember, liability here, if I, let me just elaborate. So you learned this from your undergraduate, those who are doing postgraduate, I think you learned this from your accounting 1A. Remember, liability will be credited. Remember, liability increase on the credit side. So you're gonna credit liability, and then again, remember this equity. Equity also behaves like liability. Remember the rules of account equation. So you're gonna take this again. So even this one is going to be credited when you go to the books of accounts. So you're gonna credit this. You still use those applications, and then obviously the proceeds obviously is when we receive the cash. So we're gonna debit the proceeds. So remember, we issued that, so we're gonna make sure that we debit the proceeds. And remember, this proceeds will be in the form of what we receive cash, obviously. So we're just gonna debit bank at the end of the day. I'm just saying if you want to go and affect your accounting books, especially the general journal. Okay. And again, use your accounting equation skills. Can you see here when we allocate a liability, that we allocate transaction cost to the liability? So it means here we deducted, remember, this our liability will decrease. So obviously at the end of the day, what must we do here? We will have to debit this. We will have to debit this component. This one is going to be debited. Can you see? I'm just going to write DR. Can you see now? And again here, remember, this will decrease the equity component, this 2475. Can you see now? So again here, this one is going to be debited. You see now? And then again, the total 220. Okay, so obviously if you add the 2, they will give you a total of 220. So 220 will affect the bank, because by the time when we, we need to reduce the bank at the end of the day. But again, this is another day for another thing for another day. So for now, it's just trying to show you how to calculate this, the present value and the liability component, the proceeds and things like that. So I hope this short video makes the difference, guys. So yeah, so it's all about knowing how to account in the books. So hopefully, guys, if I can have time, I can show you how to put this in the general channel. Thank you so much, guys. I hope this video is very useful to you. So remember, guys, I'm just trying to help. So it's not like it is perfect, but maybe some of you got some information on this. But again, guys, remember, for you to pass this kind of information module, so you must make sure that you read, understand your standards. Remember, because these instruments can be a little bit confusing. Remember, again, you need to know how to account, for credit losses. Can you see things like that? The allowances for credit losses, and understand that when you're dealing with the credit losses, or whether you are dealing with a financial asset or financial liability, according to the other comprehensive income or profit and loss, amortized, something like that. So again, I think you know what I'm talking about, guys. So I think you got some basics, guys, and thank you very much. And I will try to show you how to record this in the near future. Thank you very much.